Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, professor of economics at Ewha Womans University. Professor Kim, good afternoon. Thanks for coming on today.
Good afternoon, Devin.
Well, a major story this week is in China, the difficulties of the Chinese real estate giant Evergrande, which faces possible default, something that would have ripple effects throughout the financial system globally. The company's having trouble finding buyers for assets that it could sell to service its debts worth hundreds of billions of dollars. Evergrande bonds have now stopped trading. Tell us about the situation at Evergrande, or Hengda as it was called before, and what the implications might be.
Evergrande is one of the largest Chinese real estate developers, but it is suffering from unmanageable size of debt, which amounts to 1.9 trillion yuan or 305 billion US dollars. On Tuesday, Evergrande's stock price dropped by 12% in Hong Kong market over rumors that Beijing has decided to let Evergrande to bankrupt. The firm's shares have fallen by more than 80% in the last 6 months. Evergrande said its cash flow is under tremendous pressure. So it is expected that the company's debt problem could pose widespread risk to the financial system of Chinese economy and global economy too. Evergrande's debt in the form of bonds particularly have been both domestically and globally sold to Chinese citizens and major international investment firms like BlackRock, UBS, Amundi. They're all big names in the market. So Evergrande's financial problem can trigger another shock to global financial market, not to mention Chinese financial market.
Indeed, and sticking with real estate for a moment, home prices have been rising, of course, at a record pace all around the world, twice as fast actually in developed countries as in developing countries. A couple of exceptions would be India and Spain. But tell us about this trend, why it's so broad, and what you make of the situation.
Global housing market is heating up with the highest increasing rate in 2 decades. Two main factors for this rise are the lowest interest rate and extra savings over coronavirus pandemic. At the same time, the risk over the real estate market threat global financial market stability. According to Financial Times from UK, housing price in 55 countries increased by 9.2% on year as of June. As you said, Devin, particularly developed countries' housing price increasing rates more than doubled that of developing countries. In U.S., Australia, New Zealand, and Canada, housing price increase rate exceeded 16% on annual basis. One thing very interesting to housing price increasing is that the coronavirus pandemic has generated stronger demand on house related to working at home and social distancing. And it is actually further fueled government's cash out programs and increased household savings.
Right, and Professor, turning to the stock markets, Wall Street saw a bounce back overnight. Last week was rough for U.S. stocks, but Wednesday's gains were led by energy shares as oil prices rose. Looking forward to U.S. retail sales tomorrow. What's the story in the global equity markets?
U.S. stock rose Wednesday, constructing a rebound as investors tried to assess the strength of the U.S. economic recovery. Dow Jones Industrial Average advanced by 0.7%, and the tech-focused Nasdaq Composite climbed by 0.8%. Stocks have retreated this month, with some investors worried that markets are matured for a pullback after marching higher for much of this year. So it should be more watched whether market continues to go up after Wednesday's advancement. Energy was the best performing sector on Wednesday, boosted by oil rally. For example, Chevron share gained by 2.1% on Wednesday. All European markets dropped on Wednesday, mainly due to much higher than expected inflation in the region. Also, Hong Kong's Hang Seng Index dropped by 1.6% related to the possible bankruptcy of Evergrande today.
Yeah, a lot of talk about that September slowdown. Have to see if that materializes or not. Korean stocks were down today, though. Retail investors buying, institutions and foreigners selling. Shares of Naver and Kakao hit hard in the past few days. They seem to have stopped the bleeding for now. Tell us about the domestic market.
Domestic market turned to decline after 4 straight days rise. Kospi had negative 0.7% return, and Kosdaq also had negative 0.3% return today. Without dominant sectors in the market today, there were huge sales by both of the institutional investors and foreign investors. Particularly, domestic institutional investors like asset management companies, insurance companies, and securities companies led Kospi markets decline with 513 billion won net sales. Domestic institutional investors also further accelerated Kosdaq markets decline with 73 billion won net sales.
And finally, Professor, if we could look at the jobs numbers that came out yesterday in Korea. Last month, we see there were more than 500,000 more people employed compared to last August. Still declines in some areas, though, like the hard-hit in-person services and manufacturing sectors. What do you see in this data, Professor?
Korean economy added jobs for 6 straight months in August, but the growth rate pace slowed as employment in service sector was hit by the fourth wave of pandemic. According to Statistics Korea, the number of employed people reached 27.6 million last month, which is 518,000 more than a year earlier. The August job additions were lower than on-year increase of 542,000 the previous month. But job growth slowed for the 4 straight months in August as the latest in COVID-19 cases and tougher than ever virus curve dealt a blow to employment in the face-to-face service employment. As you said, service sector reported severe job erosion in August amid the toughest distancing roles. For example, the wholesale and retail sector reported fall of 113,000 jobs in August. The manufacturing sector, a backbone of Korean's economy, reported an on-year fall of 76,000 jobs last month.
All right, Professor, we'll have to leave it there for today. Thanks for sharing your insights with us as always. We appreciate it.
Thank you very much.